Well, thank you. Thank you very much for inviting me. I'd like to thank all the organizers for this. I've been asked to address one of the big economic puzzles of our time. Why has inflation been so low for so long, despite huge central bank efforts to push it up? What are the prospects in the short run and in the long run? Or if you like, if I can put it in simpler terms, is inflation dead or just hibernating? Now, the answer to these questions, I think, is going to be quite important for not just for the future of central banking, but also for that of the global economy for some of the reasons that were mentioned at the beginning. Now, a big puzzle, by definition, it's hard to solve. And moreover, as you all know, making predictions is a hazard of business. But today I will try and stick my neck out, which I normally do not do. And in order to say something about the future, of course, I will have to say something about the past first. I was thinking of giving you the bottom line of my presentation at the beginning, which is what I normally do, but I thought that on this occasion, I'd rather not spoil the story. So let me just say that in order to understand the future, I think we need to go beyond the recent experience. We need to take a historical perspective. And I think we need to consider the shifts in the tectonic plates of the global economy as opposed to just developments on its surface. Let me also qualify what I will be saying. Now, although what I will be saying is indeed of broad applicability, there are a number of countries in the world, particularly emerging market economies, for which the threat of inflation is quite imminent, or indeed they're already living through inflation. But that number is indeed becoming smaller and smaller over time. So looking back, let me start with the obvious. Central banks have played a critical role in taming inflation, bringing it down and then keeping it there. I'm sure that we are all familiar with Volcker's courageous efforts, late 70s, early 80s, efforts that paved the way for other central banks to follow in his footsteps. But surely that cannot be the whole story. Otherwise, central banks would have been able to push inflation up back to target following the great financial crisis. But they have not succeeded. They have not succeeded despite pushing interest rates to unprecedented lows, indeed in some cases into negative territory. They have not succeeded despite keeping them there for an unusually long time. And they haven't succeeded despite pushing up their balance sheets to new highs. I think we should all recall that real interest rates, inflation-adjusted interest rates, have never been so negative for so long, not even during the great inflation era. So what happened? Well, the first point to note is that the link between measures of economic slack, domestic economic slack, excess capacity, and inflation have been, the link has been quite weak for a long time, quite weak and lucid. Put it in different terms, the Phillips curve has been remarkably flat and difficult to estimate. Now, this has been a recurrent theme in discussions here in Basel, going way, way back. I remember that in the early 2000s, we had a whole meeting that was discussing this question. And I think it has been reflected in the recent decision by the Fed to play down substantially the role of an unobservable equilibrium natural rate of unemployment in the inflation process. Now, the most popular explanation for this weakening of the link is that central bank credibility, anti-inflation credibility, has weakened it because it has led to more stable, well-anchored expectations, so that both price and wage decisions have been more insensitive to measures of economic slack. Well, of course, there's a lot to be said for this hypothesis, but for the reasons that I mentioned earlier, it cannot be the whole explanation, although it is probably a big part of the explanation. In fact, recently, central banks have become increasingly concerned with inflation expectations possibly drifting down as a result of inflation remaining persistently below target. There is more and more evidence suggesting that expectations are backward-looking, so that, or at least they have a strong backward-looking element, so that people are not convinced by announcements, but they're only convinced by facts. Now, to my mind, an important complementary role is the role that globalization of product, capital, and labor markets has played. To put it simply, is it reasonable to believe that the inflation process should have remained immune to the entry into the global economy of the former Soviet bloc of China and to the opening up of emerging market economies between the 1990s and early 2000s? And this added something like 1.6 billion lower wage workers to the effective global labor force, drastically shrinking the share of advanced economies by more than half by 2015. I think this globalization process has had two effects on inflation. The first is cyclical and symmetric. By cyclical, I mean that it plays out at cyclical frequencies, business cycle frequencies, and that it, by symmetric, that it is neutral with respect to the level of inflation. The second effect is secular and asymmetric, so it plays out over longer horizons, and it puts persistent downward pressure on inflation. So what about the cyclical and symmetric effect? Well, I think one should expect labor and firms to have become much more sensitive to global conditions. And we know that workers do not just compete with workers in the same country, but also with workers abroad. We know that given a nominal exchange rate, the price of two goods, which are relatively good substitutes, should move in tandem. And we know that exchange rates have not been fully flexible so as to compensate for the differences in unit labor costs between advanced and emerging market economies. So if we can postulate something akin to a global Phillips curve, then domestic measures of slack should be insufficient measures of inflationary pressures. Global slack should matter too. So what about the secular and asymmetric effect? One should expect the entry of lower cost producers and cheaper labor to have resulted in a persistent downward pressure on inflation rates in advanced economies, at least until costs converge. Markets, in other words, should have become much more contestable, eroding the pricing power of both labor and firms so as to make the wage price spirals of the past less likely. As a result of this, changes in costs, changes in import prices would result in one-off changes in the price level as opposed to persistent changes in inflation. Now, of course, as the economy transitions from one price level to the higher price level, one would see higher inflation typically, but that would not be that persistent. Now, what is the empirical evidence for this? Well, as regards the cyclical component, many studies have found, I think indeed this is a stylized fact, that inflation has become more of a global phenomenon, that correlation of inflation rates in individual economies has increased. But of course, correlations tell us nothing about causation, and it is quite possible, indeed probable, that the adoption of inflation targeting regimes across the world should have played an important role in that stylized fact. But there is also more specific evidence. A number of studies have found that global measures of slack have information content about domestic inflation over and above domestic measures of slack. With colleagues, we did such a study in the early 2000s, and it has been followed by others. Indeed, there was a recent study by Christine Forbes recently that goes over that kind of territory. In addition, with some of other colleagues here, we have found that global value chains help to explain the relative importance of global and domestic measures of slack for domestic inflation, both across countries and over time. And we know, of course, that global value chains have increased substantially since the early 1990s, enhancing competition at all levels of production. What about the secular and asymmetric effect? Well, there is evidence that institutional indicators of the secular decline in labor's bargaining power in the form of employment protection, union density, or coverage go hand in hand with a lower responsiveness of wages to domestic slack. Now, I think it's natural to believe that globalization has played an important role behind this phenomenon. But of course, as part and parcel of a broader shift to a free market economy that we have seen since the early 1990s. And in fact, this view that globalization has played a key role in inflation, although it was limited to a few people many years ago, now has become more widespread. Indeed, some of you may have listened to Christine Lagarde's presentation at the ECB Watchers last week, where she highlighted the role of globalization. And in fact, if you go back to 2003, it was Alan Greenspan who mentioned that probably globalization had something to do with the very low inflation and stubbornly low inflation that one was seeing at the time. Now, the arguments that I've just put forward for globalization apply equally well to technological change and for very much the same reasons. And moreover, we know that globalization and technological change tend to reinforce each other. So just as globalization, technological advances should push productivity up, therefore costs down. They should threaten labor's pricing power, think of robots here as opposed to foreign workers. And they should reduce incumbents' pricing power through cheaper products, through newer products, and through more transparent prices. The evidence that exists is mainly evidence about the impact of e-commerce on inflation. But I would suggest to you that the impact is much more pervasive, and it operates at all stages of production. And I think that this is something that it would be worth investigating more closely. So here we are, in a world where inflation seems to have a life of its own, while evolving within a narrow range, stubbornly below central bank targets, and seemingly impervious to monetary policy stimulus. We live in a world in which, as evidence appears to indicate, inflation is more likely a kind of residual result of the erratic or trend movements in individual prices and reflecting a common change to all of them, which is really how inflation is theoretically defined. Perhaps the great inflation deceived us all. So the real question is not so much why inflation is so low now, but why it should have been so high during the great inflation era. And I remember that just as many economists at the time were trying to understand, and they were quite puzzled about developments then. Now, in fact, historically, high inflation in peacetime is the exception, it's not the rule. And perhaps inflation is part of the physiology of a well-functioning market economy. Remember or recall Greenspan's famous definition of price stability as a situation in which prices do not materially influence the behavior of firms, the behavior of workers, the behavior of consumers. If that's an ideal state, well, maybe we're pretty close to that. So going back to the original question, is inflation really dead or just hibernating? So here, let me just say a few words about the future and try to guess what's in store. And in doing so, I will be relying quite a bit on what we said in the annual economic report recently that came out at the end of June. Here, the key distinction is between the short run and long run, but short run and long run not really conceived in calendar time so much, but in economic time, by which I mean not today, tomorrow, the day after tomorrow. The specific timing is very difficult to predict, but rather in terms of the broad economic conditions, and in particular of the policy regimes in place. So think of this as a prediction conditional on, as a function of the policy regimes that we might see in the future. So the short term first. I think that in the short term, by that I mean roughly 1-2 years ahead, possibly longer, I think these inflationary pressures are likely to prevail. One reason is that some of the underlying factors, secular factors that I mentioned before, globalization, technology, and the like, they will continue to be operating. Partly also because the economy in general, the global economy, is likely to see excess capacity for quite some time. And although, as I mentioned earlier, the link between excess capacity and inflation is not particularly strong, it does mean that it should not be a source of inflationary pressures, if that, of course, if that statement is correct. Moreover, it is true that we are likely to see, and that we have already seen, cost push increases in prices as a result of the pandemic and of the contraction in supply. But if my argument before is correct, these are more likely to have an impact, or a temporary impact, on inflation than a permanent one. Now, the picture in the long term, however, seems to be different. It is possible that in the longer term, inflation should reemerge as a policy problem, as the legacy of the pandemic accelerates previous trends. So imagine a world in which we have much higher private and, above all, public sector debt. And we know that debt was steadily increasing in relation to GDP before the pandemic. And that, of course, the pandemic has given it a big push. Imagine a world in which globalization is in full retreat. We have already seen some signs of that, as firms have onshored part of their operations in order to reduce their vulnerability to global conditions. Imagine a world in which the role of the state in the economy is much greater. Again, the pandemic is working in that direction, and so is the progressive erosion of the policy room for maneuver. Now, in such a world, there would be both the incentive and the ability to raise inflation. Incentive to generate higher inflation, but I would say in a less controlled fashion, in order to inflate the debt away. Of course, coupled with financial repression, which I think is important in order to prevent interest rates from increasing. And also the ability, because in closed economies, you would provide both labor and capital, or labor and firms, with some of the pricing power that they had previously. And of course, it's also likely that in that environment, central banks would be less independent than they are now. And I hope that very much that does not happen. Moreover, the outcome would be more likely if the political environment became more inimical to market forces and also to central bank independence. In fact, historically, the link between a philosophy which is very much free market oriented and an independent central bank has been quite tight, and I developed that in some of my previous work. Remember that the previous era of central bank independence was the first globalization wave during the gold standard. So the pandemic again is working very much in that direction. So in fact, high private sector debts aside, the environment that I've just described would not be so different from that of the 1970s. At the time, there was little globalization, with the Soviet bloc and China almost planets of their own, and with emerging market economies very much close to the rest of the world. There was financial repression, lots of controls and constraints on the financial system. There was a bigger role of the state, and central banks were not independent. Now, if such a world materialized again, the winter of hibernation would have been quite a long one, but just a winter nonetheless. Thank you very much.